Okay, welcome back to Dividend Investing with Lincoln. Hey look, today I want to just go over 5 key things that you really need to know before investing in business development companies, or BDCs. So if you want a piece of this, if you want to see some returns like this, stay tuned and learn how you can get some of these returns. Okay, so the first thing that we probably want to think about is how investing in BDCs can be risky, but they do have high yields and these high yields can be safe. Now, of course, this is always contingent on you investing in the right BDCs, the safest and the highest quality BDCs. Now, I'm not making any disclaimers today about which BDCs these may be, but I am going to give you some examples of some of the BDCs that I like the most. So here is Ares Capital Corporation, ARCC, and as we can see from the window here, a total annualized rate of return of minus 41%, which is a total loss here of minus 66%. Now, those numbers don't look too terrifying, but if you look here, it's actually minus 83%. So out of every $1,000 you invested, you've gone down $830. Now, you've picked up quite a few dividends along the way, which does help, but minus 83%, it's a whopping great big price decrease. So look, there can be significant declines in the prices of your investments into BDCs, but price is only one half of the picture. If you flip this around and you begin to look at yields, we can see yields that will be safe. So using Stock Rover, we can get a little bit of insight into Ares Capital, for example. Now along the top here, we can see fairly consistent, fairly stable dividends paid out over time. We can see that in the 2008-2009 period, they did decrease their dividend payments a little bit. They then bumped them up again by 2012, and they've been holding them fairly constant ever since. Now, some of this is going to be regular dividends, and some of this will be special dividends. For example, down here in 2012, we can see a special dividend of 5 cents paid out near the end of the year. And more recently, in 2022, for example, we can see a number of these special dividends going into the payouts each quarter there. Now, the year before that, of course, it was just all regular dividends, and we can see over the last several years we've got regular dividends of 40 cents in 2019, 40 cents in 2020, and no dividend cuts during the pandemic. 2021, we saw a bump up to 41 cents a dividend quarter, and then in 2022, a bump up to 42 cents, and then the regular dividend here, quite a big bump up from 43 cents even to 48 cents for the quarter. So we're seeing some very, very nice, reasonably high yields here, which are safe. Now, if we look at the total returns, even though prices for Ares Capital have gone sort of sideways, up and down a little bit, the total return has been quite strong, pumped up by these dividends. So yes, you can have some price fluctuations, but look at these high yields. They are good and they are safe. Now, Ares Capital isn't the only BDC. Probably my favourite BDC when I can buy it at a good price is Main Street Capital. Now, Main Street Capital also has some nice growth there. And you can see this beautiful run here, 13 cents per dividend per month, up to 14 cents in 2011. There was no cuts there at all during the global financial crisis even. 14, 15, 16, 17 cents, some special dividends thrown in there as well, 18 cents, 19, 20 cents a month, 21, 22, and now 23 cents a month declared into 2023. So, yes, there can be some price changes, but you've got high yields, and with the right selection of the right BDCs, this can be a safe yield. Point number 2, supplemental dividends are nice, but they are not necessary. Now, this is still on Main Street Capital. We can see that in 2022 there was a special dividend here of 7 cents a share, 7 cents a share up here, 10 cents a share there, and 10 cents a share there. That's nice. Icing on the cake. It is not necessary. Now, all of these BDCs are structured differently. They're all investing in different ways. Now, Main Street and Ares Capital, for example, also have some investments into equity. So not only are they lending money to companies, but they're also taking equity stakes. Now, those can often take years to play out. and when they get rid of those stakes, they sell those stakes, they get some capital gains, and that has to then be paid out, and they can use the special dividends to distribute that. So it's nice to have, but it's absolutely not necessary. You can do very, very well with BDCs just with regular dividend payments. Focus on your total returns. Now, as we just said, most BDCs are not going to have strong price changes over time, but they'll have good total returns driven by high yields. Here again, coming back as Main Street Capital, we can see here in grey there is some price appreciation, which is wonderful, but there's also strong growth driven by dividends. Now, as we switch between a couple of these other BDCs, we see similar comparable patterns. So if we switch over to Ares Capital, for instance, we can sort of see again strong growth and total return driven by high yields, but middling sideways performance in terms of price. And so we can sort of see that pattern repeated quite over and over again. Hercules Capital, for example, again, similar to Ares Capital, sideways price movements, but strong total returns driven by dividends. So when you're looking at a price chart, don't just look at a price chart for BDCs, but think about the total return, not just the price movements, but also that return from dividends. Now, if we just contrast that to a price chart, we're just going to see this lackluster performance here in grey, which doesn't really seem to go anywhere. It's not exciting. But when you take this total return into account, all of a sudden you can begin to see the benefit from some of these monster yields. What else do we need to know? Well, valuation matters. Don't just put money and invest into BDCs at any time. So here we are on fast graphs. Now, when we look at fast graphs, we can begin to see some pretty important things. It allows us to go back and sort of assess what these returns may have looked like. So for Ares Capital Corporation, so this is if we entered in 2016 at a point which is a bit below the sort of the normal price earnings line here, and we held it through to today, we would have had a total annualized rate of return. This is price and dividends of 12.4%. So that's a reasonable purchase price, at a reasonable price below the normalized PE line there in blue. But what happens if we take an entry point at a different point in time? If we had entered a little bit later in 2017, early 2017, we can see prices are a bit above the normalized PE line, and we held it through to today, we would have had an annualized, total annualized rate of return of only 9%. So valuation does matter. When you can pick up a BDC at a low price, we can get some very, very, very nice rates of return. Finally, if we picked up Ares Capital after the pandemic crash at a reasonable price, and we held it through to today, we would have had a total annualized rate of return of about 23%. Valuation does matter. Buy BDCs when they're selling at a good price, and you can do very well very quickly. One final note. Yes, BDCs lend money. Yes, they take equity stakes in companies. And yes, these are going to be smaller companies which are going to be a little bit more fragile. This does not mean that these are not safe investments in your BDCs. Yes, they can have loan default rates. But when we begin to look at how, for example, Ares Capital has invested their money, we can see here in this pie chart that almost half of their investments are first lien senior secured loans. These are BDCs which are going out there being very careful with their investments. Here we can see they've got a lot of security. If something goes wrong with these companies, you can bet your bottom dollar that Ares Capital is going to get most of their investment back on this first lien senior secured loan tranche. When they're assessing companies, they're going to be looking at assets, they're going to be looking at cash flows, they're going to be making sure that there's enough real assets there that in the case of liquidation, and in case of bankruptcy, they can begin to recover at least a large portion of what they've lent out. Similarly, with the second lien senior secured loans, also quite a bit of security there. We can see preferred equity, we can see other equity. So when we begin to look at Ares Capital, we can see there's a lot of benefit here. Yes, they have some slightly riskier loans, but a huge proportion of their portfolio is going to be very, very secure. Now, if you also begin to look at this, looking at the industry spread, they have quite a wide diversification over the different sectors of the economy. Some of these sectors are going to do well, some sectors will do more poorly. But overall, with a balanced portfolio that's been carefully constructed, such as we can see here for Aries Capital, you can be sure that they're not going to have high levels of loan losses. They have been very careful and secure as they begin to put together these portfolios.